Here's something most new investors never think about until it's too late. By the end of this video, you'll know exactly whether you should put your money into one industry or spread it across many. And I'm going to give you a framework that most financial advisors charge hundreds of dollars an hour to explain. So here's the deal. When most people start investing, they gravitate toward what they know. You work in healthcare, you buy healthcare stocks. You love electric cars, you buy EV companies. You think AI is the future, you go all in on tech. It feels logical. It feels smart. You're betting on what you understand, right? But here's what actually happens. When the dot-com bubble burst in 2000, tech stocks lost an average of 80% over 2.5 years. Investors who'd put everything into tech funds saw their portfolios evaporate. Not a few percent, evaporate. And it wasn't just tech. Oil collapsed in 2014 and 2015, taking energy stocks down 40%. Real estate imploded in 2008. Even utilities, which everyone calls safe, dropped over 20% in 2022 when interest rates spiked. The pattern is always the same. Concentration feels like confidence, until it doesn't. Now here's what most people never consider. There's a middle ground between putting everything in one basket and scattering your money across 5,000 random stocks. Sector ETFs let you bet on an entire industry without betting on a single company. Instead of picking one tech stock and hoping it outperforms, you buy a fund that holds 50 or 100 tech companies at once. The biggest tech sector ETF is the Technology Select Sector SPDR, ticker XLK. It holds over $160 billion in assets. Its top holdings include Apple, Microsoft, Nvidia, and Broadcom. If any single one of those companies tanks, the others absorb the hit. And here's what makes this interesting. XLK returned over 40% in 2023, while the broader market returned about 26%. So sector ETFs can absolutely amplify your returns when you're right about an industry. But here's what nobody warns you about. Being right about a sector and being protected from that sector are two completely different things. In 2022, XLK dropped almost 30%. If you'd put your entire portfolio into that one ETF, you would have watched $40,000 or $50,000 turn into 30. And that's through an index fund. So yes, sector ETFs reduce company-specific risk, but they do not reduce sector risk. They concentrate it. If you're finding this helpful so far, hit subscribe. I put out videos like this every single week. And the next part is where most people finally understand why their sector bets keep underperforming. Okay, here's the framework nobody teaches you. The research from Vanguard's investment team shows that most investors dramatically overestimate how much they know about specific sectors. A 2023 Dalbar study found that the average investor who concentrated their portfolio in a single sector underperformed broad market returns by over 4% per year. 4%. Over 20 years, that's the difference between $1 million and $1.8 million. But here's what the study also found. Investors who allocated 10 to 20% of their portfolio to sector bets they felt confident about, while keeping the rest in broad index funds, outperformed by roughly 3% annually compared to investors who only held broad index funds. That's not a typo. A modest sector tilt beat the market. Not because the sector bet was genius. Because having skin in the game in an industry you understand actually changed how you behave during volatility. You stopped checking your portfolio every day. You stopped panic selling at the bottom. And that behavioral edge compounded over time into real money. The practical structure is this. 60 to 70% goes into a broad index fund like the Vanguard Total Stock Market ETF or the S&P 500 ETF. Boring, steady. It captures overall market growth without any guesswork. The remaining 30 to 40% goes into sector ETFs where you have actual conviction. Maybe that's healthcare because you work in the industry. Maybe it's energy because you understand commodity cycles. Maybe it's technology because you track the semiconductor industry closely. The key is that your conviction has to be earned, not based on a podcast you listened to once, not based on a stock tip from a friend, based on genuine knowledge and genuine comfort watching your money fluctuate in that space. And if you don't have that conviction, that's fine. Just use the broad fund. The data is very clear. Most people are worse at picking sectors than they think they are. So here's what to take away from all of this. Sector ETFs are not a shortcut to getting rich quick. They are a tool for expressing informed conviction within a disciplined structure. The trap most people fall into is treating them like a lottery ticket, one industry, all in. And the moment that industry has a bad year, they panic and sell at the bottom. The right approach is simpler. Understand the industry. Allocate a portion you're comfortable losing. Let the broad market hold the rest. That combination has historically outperformed both extremes. So next time someone tells you they're all in on one sector, you can ask them one question. What's your plan for when that sector drops 30%? If they have an answer, they might know something. If they don't, They're just gambling with extra steps. If this helped you think about your portfolio differently, share it with someone who's been agonizing over whether to go all in on one industry, and subscribe if you want videos like this every week. I'll see you next time.